Let us set aside the noise of the weekend and look directly at an extreme geopolitical scenario. A large-scale military campaign by the United States and Israel targeting strategic sites inside Iran, including military facilities and the highest levels of leadership. Tehran responding with missiles and drones aimed at Israel and U.S. and allied bases across the Gulf, and at the peak of the crisis, Iran's supreme leader killed in a publicly announced strike. Such a scenario alone would be enough to shake the security architecture of the Middle East, disrupt global energy markets, and rattle an already fragile international financial system. To understand why a confrontation of this magnitude, if it were to occur, would have consequences far beyond the battlefield, we must see it as the intersection of multiple overlapping layers of interest: regional power balances, energy security, the role of the U.S. dollar, and the ideological foundations of the Islamic Republic of Iran since the 1979 revolution. The Middle East is not merely a theater of religious tension or territorial disputes. It is a crossroads of the world's economic arteries. Every day, a significant share of global oil supply passes through the strategic maritime choke point linking the Persian Gulf to the Indian Ocean. Even the mere risk of disruption, without an actual blockade, can send shockwaves through markets. Oil prices surge, gold climbs, and capital flees from risky assets toward perceived safe havens. This is not emotional overreaction, it is the financial system's survival instinct. For Iran, geography provides a unique lever of influence. The country sits adjacent to one of the planet's most critical energy transit routes. When tensions escalate, even the suggestion that oil flows could be threatened compels the world to pay attention. Yet that leverage is also a double-edged sword. It places Iran at the center of strategic calculations in Washington, Tel Aviv, and Gulf capitals. If a major oil shock were to occur, the consequences would not stop at higher fuel prices. Global inflation could reignite just as many economies struggle to contain price pressures and manage rising public debt. Central banks might be forced to reconsider monetary policy trajectories. Supply chains, already strained by previous crises, would face renewed instability. For the United States, the world's largest economy and also its largest debtor, even a modest increase in borrowing costs translates into hundreds of billions of dollars in additional long-term fiscal burden. Here we encounter a deeper layer of the story: the role of the U.S. dollar in global energy trade, often referred to as the petrodollar system. Following the upheavals of the 1970s, a financial structure emerged in which oil on international markets has been predominantly priced and settled in U.S. dollars. This was not a legal mandate, but the outcome of agreements, shared interests, and entrenched practice over time. The implications are profound. Any country wishing to import oil must first hold U.S. dollars. That structural demand generates a stable global appetite for the currency, reinforcing its position as the world's primary reserve currency. When the dollar stands at the center of payment systems and reserves, the United States enjoys the ability to borrow at relatively lower cost, impose financial sanctions more effectively, and project influence far beyond its geographic borders. Imagine the global economy as an enormous marketplace. The United States issues vouchers called dollars. Because oil, the essential commodity, is sold in those vouchers, everyone must keep them in their pockets. When demand for those vouchers is constant, the issuer holds an advantage. But if one day major oil suppliers begin accepting multiple currencies, euros, yuan, or alternative bilateral mechanisms, the compulsory demand for dollars diminishes. When demand falls, the currency's value and bargaining power may weaken over time. For Washington, this is not merely a question of exchange rates. It is about the ability to finance deficits, sustain financial superpower status, wield sanctions as leverage, and maintain investor confidence worldwide. If investors begin demanding higher yields to hold U.S. Treasury bonds because they perceive greater risk, the cost of servicing government debt expands. Funds that might otherwise support infrastructure, defense, or social programs must instead be diverted to interest payments. In that context, any move by a major oil-exporting nation to diversify away from dollar-denominated trade is viewed through a strategic lens. When Iran explores mechanisms to conduct transactions outside the dollar system or deepens financial cooperation with other major economies, it is not only attempting to circumvent sanctions, it is touching a global power structure that has existed for decades. Yet, to understand why Iran might accept such high risks, one must return to the political foundations of the Islamic Republic. After the 1979 revolution, the Iranian state was constructed upon resistance to American and Western influence. This is not merely an external slogan, it forms part of the regime's internal legitimacy narrative. Within that structure, the supreme leader is not simply a political or religious authority. He embodies ideological continuity. Nuclear policy, missile development, and regional networks of allied forces are tied to the concept of strategic resistance and autonomy. If the system were suddenly to pivot dramatically, offering sweeping concessions under external pressure, fundamental questions would arise domestically. What was the meaning of 40 years of confrontation? Who bears responsibility for past sacrifices? This is the essence of a strategic dilemma. Continuing confrontation brings sanctions, isolation, and military risk. Retreating too far risks undermining ideological legitimacy and triggering internal power struggles. In such an environment, every major decision becomes existential. From the perspective of Washington and Tel Aviv, if the current power structure in Tehran is perceived as the source of policies deemed threatening, then targeting the center of that structure can appear both symbolic and strategic. In military theory, decapitation seeks to deliver a shock large enough to paralyze command capability or force recalculation. Historically, the United States at times has favored targeting central figures rather than committing to prolonged ground wars. The underlying assumption is that systems heavily reliant on a single individual may destabilize when that individual is removed. Yet reality is often more complex. The fall of a leader can produce fragmentation, but it can also trigger rally-around-the-flag effects, hardening internal factions and intensifying national resolve. Publicly announcing such an operation, if it were to occur, would carry psychological weight. It would send a deterrent signal, not only to Iran, but to the entire region, demonstrating how far escalation might go. In international politics, symbolism can matter as much as battlefield gains. A public declaration transforms military action into strategic messaging. But every move invites a countermove. Iran possesses missile capabilities, regional alliances, and influence across multiple flashpoints. A cycle of retaliation could quickly exceed initial intentions, drawing in third parties and reshaping the entire Middle Eastern chessboard. Ultimately, if we look beyond rhetoric about regional stability or defending international order, we encounter a familiar rule of great power behavior. National interest serves as the compass. Major decisions are weighed against pragmatic questions. Does this enhance security? Does it preserve strategic standing? Does it protect vital energy lifelines? When a state perceives threats to core interests, whether allied security, military assets, or vital energy flows, the response tends to reflect raw power politics. This does not mean the world is governed solely by cold calculation, but in moments of crisis, realism often overshadows idealism. And thus, a seismic event in Tehran, whether real or hypothetical, could become a catalyst for far-reaching shifts in oil prices, interest rates, bond markets, and regional power alignments alike. In an interconnected world, the tremor of a single fault line can travel far beyond its origin. The Middle East is not just a regional story, it is part of the global economic nervous system. And when great powers act to defend what they perceive as core interests, the response tends to reflect raw power politics. This does not mean the world is governed solely by cold calculation, but in moments of crisis, realism often overshadows idealism. And thus, a seismic event in Tehran, whether real or hypothetical, could become a catalyst for far-reaching shifts in oil prices, interest rates, bond markets, and regional power alignments alike. Thank you for watching this story. If you found it meaningful, please subscribe, turn on notifications, and share this video. And now it's time to say goodbye. Thank you for staying with Societal Stories.